Imagine you have some money, let's say $1,000. You have a few options for what to do with it. You could put it in a savings account, you could invest it in the stock market, or maybe you're thinking about starting a small side business. Each of these choices represents a different path you could take with your money. Now, let's focus on the idea of opportunity costs. Opportunity cost, at its heart, is about trade-offs. It's about recognizing that when you choose to do one thing, you are simultaneously choosing not to do something else. It's the value of the next best alternative that you give up when you make a decision. Think of it like this. You have a free Saturday afternoon. Option 1 is to go to the park for a picnic with friends. Option 2 is to stay home and finally organize that closet that's been driving you crazy. If you choose the picnic, the opportunity cost is not having a tidy closet. If you choose to organize the closet, the opportunity cost is missing out on the fun and fresh air at the park. Both options have value, but by picking one you automatically forgo the benefits of the other. The opportunity cost of capital applies this same idea to money, or what we call capital. Capital isn't just cash in your pocket. It can be any resource you use to generate wealth or value. For a business, capital could be money, equipment, buildings, even time and employee skills. So, when we talk about the opportunity cost of capital, we're asking, what are we giving up by using our capital in a particular way? Let's say a business has $1 million. They could use this $1 million to buy new machinery to increase production, or they could invest that same $1 million in a safe government bond that earns a guaranteed interest rate. If the business chooses to buy the machinery, they are hoping that the increased production will generate more profit than they would have earned by investing in the bond. But the opportunity cost of investing in the machinery is the potential return they could have earned from the bond. That foregone return from the bond is the opportunity cost of capital in this scenario. It's what they gave up to pursue the machinery investment. To make this even clearer, imagine the bond would have earned a 5% return or $50 in a year. If the business chooses the machinery, they need to make sure that the machinery generates profit significantly higher than $50 just to justify their decision from a purely financial perspective. If the machinery only generates $40 in profit, then in hindsight, the business would have been better off simply investing in the bond. They would have lost out on $10 in potential earnings by choosing the machinery. The opportunity cost of capital is essentially the minimum return a company or investor should expect to earn on an investment to make it worthwhile. It's a benchmark. It helps them evaluate if a project or investment is truly profitable when considering all available alternatives. It's not just about the return on a single investment in isolation, but about how that return compares to other potential uses of that capital. Understanding the opportunity cost of capital is crucial for making sound financial decisions, whether you are a large corporation, a small business owner, or even just managing your personal finances. It encourages you to think critically about your options, evaluate the potential returns of different choices, and make informed decisions about how to best allocate your resources. It reminds us that every financial decision comes with trade-offs, and understanding those trade-offs is key to maximizing value.